We're going to wind up this chapter by talking about petty cash and banking. So what is petty cash? And less common anymore are instances where someone would come in and bring a delivery and we would have to pay some sort of small amount on the spot for some sort of fee. Again, it used to happen, not quite so common anymore. But let's say the boss is out, and I mean this is one of the reasons that when I had staff, I kept petty cash, because inevitably I would be in court someplace and somebody would discover we were out of something, and the last thing I needed to have happen is to have me interrupted and to have somebody say, hey, we're out of copy paper, and we can't do anything until somebody gets copy paper, and now I've got to stop what I'm doing. So petty cash was a small fund. I used to keep a $50 petty cash, and literally in cash, $50 in a bank bag, and I had one specific individual who had access to the petty cash, and so she was the petty cashier. And if we ran out of toilet paper in the middle of the day, or it's a small office, so sometimes things like that happen, or copy paper, or something happened, somebody had to overnight mail something immediately, and there was nobody in the office that could use a card to do that, and so somebody had to run up to the post office and pay an overnight mail fee. So that's often how the petty cash was used, and so that person needs to come back to the office with a combination of a receipt and change that matches the amount of money that they walked out the door with. And if that doesn't happen, the petty cashier needs to hold them accountable. But the first thing we need to do is we need to create our petty cash account. So we're going to take the money out of cash. So we're going to credit cash and debit the petty cash account. And so now we've got transactions that are going on. And again, you might give somebody a $10 bill to go down to the convenience store and get toilet paper. So they better come back with the toilet paper. If the toilet paper costs $4, they better have $6 in change and a $4 receipt for the toilet paper. And that then goes back to the petty cashier, who records what it was for. And so at all times, the petty cash account, I used to keep it in a bank bag, would have receipts or coins and dollars totaling the $50 that I funded the account with. At the end of the month, and I would try not to keep less petty cash in there than I thought we were going to need in a particular month. But generally at the end of the month, there would be a reconciliation. The receipts that were gathered, came back from purchases, would be gathered all up. Those would get recorded, and the petty cash would get replenished. And this is the journal entry that would do that. So you would have one journal entry. There's all kinds of miscellaneous things that you're going to encounter in petty cash during the month. Probably not merchandise inventory. You better not be buying your inventory out of petty cash. But a delivery expense, some small things. Always worry about miscellaneous expenses that are, in that amount. But who knows? That could be multiple miscellaneous expenses. And so you will then credit cash for the total of all of those receipts. All of these transactions have now been recorded, and there should be $3.70 in this example still sitting in the petty cash box or bag or whatever you keep it in, and that should add up to the original amount that was there. Now, sometimes you will find that either you are carrying too much petty cash or not enough petty cash in the account. If you find that you get to the end of the month and you still have a lot of petty cash, there's still a lot of cash in there, perhaps the balance needs to decrease. By the same token, if somebody's coming to you saying we're out of petty cash and you need to increase the petty cash account, if that's happening too often, then chances are you don't have enough. Either you're planning really poorly in the course of how you, you know, replenish supplies and deal with your operations, or you're just underfunded the petty cash account. So the top one is how we would increase the overall balance. It's the same as the entry to open it. The bottom journal entry is what we would do if we needed to decrease the funds in the petty cash account. So again, this is not what we would do to reconcile at the end of the month with receipts. This is just overall if we discover that the amount that we have determined to be held in petty cash was not the right amount. When the petty cash fund gets reconciled, just like with the cash register, sometimes you will get cash over and short. Somebody comes back and they didn't have a receipt. Now, generally, the petty cashier is going to be the one that's held responsible for that. So often that person will have to, you know, write something that explains how they lost the receipt between the convenience store and coming back to the office. And if that happens with any degree of frequency, that's perhaps something that warrants further investigation. But if there is the cash over and short, you will use that for the to balance out the reconciliation at the end of the month. So if the total of the receipts that you have and the total of the change that's left does not add up to the beginning balance, you're going to use that cash over and short to balance that out. And so we're going to wind up with talking about basic bank services. And this is something that I've spent more time on in recent years as fewer and fewer students actually have checking accounts or accounts that they may have checking accounts but may not have physical checks. So what happens when you go to a bank and open a checking account? There's a signature card. Why do they want a signature card? Because theoretically you're signing paper checks. They want to be able to compare the signature on the check that comes in to the signature card that's on file and make sure that they are the same. There are deposit tickets, which if you're operating through a company, you're not using a mobile app to make deposits. You're going to probably use a paper or an electronic deposit ticket. Companies will have a bank statement, which the bank provides them once a month. They will compare that with their paper statement and make sure that the amounts agree. Often students get in the habit, and my own children as well, despite their advancing ages, of just relying on the bank balance in the mobile app to tell them how much money is in the bank. But the problem is if you've written a check to somebody and they haven't deposited the check yet, unless you remember that, the money that's in the account there isn't all available to you, because if you take all that money out and somebody deposits that check later, you're going to have an overdraft situation. The deposit tickets, and I'm not in my office, which is unfortunate, because not only does each account have its own pre-printed set of deposit tickets, but each account's the little book they come in, they're carboned. So if I write a deposit ticket and tear it out and take that and the deposit to the bank, there's a yellow copy that remains in the book, and they're all dated. And then if I've got to go back and look at a deposit record later, I've got the actual carbon copy of the deposit ticket that I wrote. The books themselves have a little cover. There's like a little cover and back to the book, and they are different colors depending on the account. And the reason that they're different colors is when I'm busy and I am dashing out the door and I've got money and I need to make a bank deposit, if I reach in the drawer where the deposit tickets are and they're all the same color, I write on the front of them which account that they go to, but having that visual reminder of the fact that the accounts are different colors and they're at different banks. So I know if I'm going to bank A, uh, that's already a clue that I'm not looking for the beige colored deposit tickets because that's not at bank A. um, so that's one of the ways that I use to prevent myself from making sloppy mistakes when I make deposits, because again, it happens. Uh, Checks are something that businesses still write. And when I'm, even large companies, if I'm paid for something, it's most likely by check. I had a recall on a dehumidifier, and I had to, the company, it was defect, and they wrote me a check for the recalled dehumidifier after I sent them proof that I was no longer using it and I had dismantled it. They wrote me a check. So this was something that when there prior to the advent of mobile banking, everybody wrote checks because you had no way to pay for anything without writing a check. That was how you did it. You either had cash or you wrote checks. Cash was easy to lose. Checks, you could, even if somebody stole your checks, you could call the bank and cancel all the checks that were stolen, and then nobody could write money off your account. And so it was a safer way than cash. The convenience of mobile banking has really eliminated most personal check writing purposes. I often will pay my utilities online, so it's rare that I even physically write a check, but I always keep checks in my checkbook or in my purse just in case I run into a situation where somebody doesn't take a card or there's not an electronic payment opportunity. But it will, and a check is basically a contract. It's a date to somebody, and it's signed, and it says that, I agree that there is money to pay this person in this amount as of this date, and that person can go take it to the bank, literally. Now, at the end of the month, the bank statement will show up. And if you aren't looking at your bank statements, I encourage you to go online and download those, or if they still come in the mail, open them, and you will see a chronological listing of all the transactions. And then you will see the a grouping of them. They will have the checks and the deposits probably all segregated, but initially you will see them all grouped together. And what do you do with this? Well, the answer is you will prepare a bank reconciliation. And this is the way that we match our accounting records to the bank's records. Now, you get this bank statement in and we pull out our check register. They're not going to match. And they're not going to match for a variety of reasons. They're not going to match because the company has probably written a number of checks that haven't yet shown up to the bank. Sometimes, deposits will get made late in the day, and if the bank has, the bank's banking day might end at 3 or 4 o'clock, and if a deposit comes in at 4:30 on the last day of the statement period, that deposit will actually appear on the following month's bank statement. So my records will show that I made a deposit, for example, on October 31st. But if I made it after 4:30 or at my bank after 4 o'clock, the bank's records will show that on the November statement on November 1. So I need to have a way to reconcile the transactions which I know about, but the bank does not, or the bank did not record. Similarly, sometimes there are transactions that the bank records that I may not be aware of. So if there are bank fees associated with that, if somebody bounces a check to me and I think there's money in there and the bank has, returned that check, that bank statement is the way that hopefully they'll send me a notice as well, but certainly the bank statement is the way that I reconcile that. So the way that we do this is we take the bank statement and we look at our account, and we take the ending balance of the statement, and often it will say current balance or the balances of the end of the month, and that's where you start. You add in any deposits which you made at the end of the month that didn't get posted to the bank prior to the statement coming out. You subtract from that any checks that you wrote that the person hasn't yet deposited those checks yet, but you've recorded them in your book balance. And if there's any corrections or bank errors, but hopefully not. So generally, and the deposits in transit is going to be really something that happens at the end of the month. And so you may or may not even have that situation. You will probably have outstanding checks. So you've got your bank balance per the bank statement, you add any deposits in transit, subtract any outstanding checks, and you've got a balance there. Meanwhile, now you go to your check register. You add in any interest. I didn't talk about interest. So if you've got an interest-bearing account, you're not going to know what that is, but it'll be on the bank statement, so you put that in there. If there were any bank fees, that's where you're going to subtract those. And hopefully there's no errors. And so your adjusted bank account balance and your adjusted book check register balance after those two exercises are complete should be the same number. If it's not the same number, you have a problem somewhere. And this is where you have to start picking back through your transactions. But the reason that we do this is to make sure that we have accounted for all transactions, and if there are any errors, that we have corrected those. So again, this is kind of a flow chart that starting with the bank statement on the left and the check register, your account register on the right, and at the end, those two balances should be the same. So I'm going to really quickly walk through the steps to do this, and I've already kind of described it, so hopefully this will close up any gaps. But we've got the bank statement balance on the left, our checking account register balance on the right. To the left, we add any deposits that the bank didn't record that we made during the month. And then we subtract any checks that we wrote that didn't actually make it to the bank. And the outstanding checks might not just be from that month. You might have outstanding checks, and this makes me crazy when I write somebody a check and they hold it for 3 or 4 months, because the outstanding checks are going to stay here until we've either stopped payment on them or somebody's cashed them. And quite often I will call somebody. If I've sent somebody a refund check and they haven't cashed it, I will get on the phone with them and say, can you please cash the check? I am sick of having to account for this every month in my bank reconciliation. And so we get our adjusted book balance. We go over here to the right side. We've got our register balance, collected note. I'm not going to talk about that right now, but interest earned, and then check printing charge. So there may be fees associated with that you're going to deduct, and then that gets you to the adjusted book balance. Again, those should be the same. Now, those adjustments that we made on our side, we need to not just, it's not just enough that we've reconciled the account, but there are real differences now that for things that occurred in our bank account during the month that we need to record so that our books are correct. The collection of the note I'm not going to talk about because that's more than I want to address today. But interest revenue is pretty common. So now we need to record the fact that we got interest revenue. So it's going to be a debit to cash, credit to interest revenue. Sometimes when you order checks, if you order them through your bank, the bank will then charge your account for them. the fee to print the checks, and you won't often know about it till you see your bank statement and you go, oh, wow, those checks were expensive. Never are they $23, by the way. But anyway, uh, so that's a miscellaneous, they've recorded it as a miscellaneous expense. I tend to record it as an office expense or supplies expense or something like that. Uh, and then a check that's been returned to us. So somebody wrote us, or excuse me, yeah, somebody wrote us a check. They bought something from us and the check bounced. So now they owe us money. So we're going to create an accounts receivable for that person. And then we're going to credit the cash. And now we're going to chase that person down for that. And that's it for banking. I'm just going to talk a little bit about some ratios that are worth noting. And these are some of the metrics that a company can use to sort of compare themselves across, similar companies of similar sizes to get an idea of how they stand up in relationship to their counterparts in the industry. And one of them is days sales uncollected, also known as days sales outstanding. And so that is accounts receivable over net sales and then multiplied by 365. In other words, 365 days a year. And what this will tell us is how many days sales in sales amount is still uncollected. And so ideally we want to keep these numbers as low as possible. We don't, if we're doing a cash business, this isn't going to be an issue because we're collecting everything on the spot. If we have a long collection cycle, that's something we want to keep an eye on because it's going to impact our cash management. And so I'm going to stop this video here. I've included the appendix if you want to look at ways to control cash, but I'm not going to go into those in this video.